thank you everyone for taking time this evening to visit with me as it relates to risk and risk management. And the title there, Tips for Managing Risk in Challenging Times, is as we all know, an understatement. 2020 is going to go down in the annals of in a whole lot of different areas and regions and businesses and people and all of those things, but work industry as well. And so I look forward to the opportunity engaging with you guys and just talking through different opportunities that could be presented to us in a bit of a challenging time here. So what I'd like to do is I'll just start out here with and review a couple tools new tools in the toolbox. We're going to talk about the new CME cutout contract that may get released, and it might be an opportunity for some of us to utilize that new product from the exchange. Also, I want to talk a little bit about livestock insurance. We all are very familiar with how the federally subsidized row crop insurance works, but most recently they've changed some rules on the livestock side of things, particularly hogs and cattle. Makes it a bit more attractive to consider that as well. So I'd like to spend a few minutes on that this evening as well. And then I couldn't resist. I'm going to spend just a little bit of time talking fundamentals and give you, if I can, my perspective on what's happening today and talk about all of the things from a fundamental perspective that's impacting these markets. And then we'll talk a little bit about some of the tips that I've learned through the years in terms of managing risk, and hopefully that's helpful to you to kind of take a step back and get a little perspective when we go about making some of the most important decisions on our farm, which is deciding when to transfer risk and hedge a margin. So, and then at the end of this, I'd like to spend also a little bit of time just talking about what our specific recommendations are for 2021. So with that, I'll just hop into it and we'll talk about the potential for the CME exchange contract based upon cutout. I'll talk a little bit how it would look and how it would work. And I thought it'd be a good idea before I got too far into that, and I apologize for the small print here, but just a little bit of a reminder on how the CME index is calculated. The CME index is primarily driven out of bucket number 3 here on the 201 report. This is a prior day 201 AMS USDA report that gets printed every afternoon. And the primary volume driver is all of the swine and pork market formula contracts that most of us engage in terms of establishing a transfer price to our packers. And so the swine and pork market formula bucket has changed significantly recently as more people have moved to a cutout-based contract. The CME index has sort of flowed that way too, but the exchange is now talking about offering a cutout-based contract alongside the CME index contract. As we all know, there's been a wide discrepancy between cash-based contracts and cutout-based contracts, and so when there's this wide discrepancy, it becomes easier to identify how much volume is maybe cash-based versus cutout-based. And so there's another report the USDA releases that we use for this exercise, the 215 report, and gives us a pretty good idea, I think, of how much influence cutout-based contracts have on the index today. 21%, 14% cash-based, way down at $16 below par, below option basis there. And then in the middle, a pretty heavy influence of index cash as well as index cutout contracts that also are influencing how that index is calculated. And so this cutout contract, if or when it comes on board, will be very similar to the CME index contract, the current futures contract that we're all familiar with today. Same trading hours, same contract units, 40,000 pounds. We'll use the same guidelines as it relates to trading limits as lean hog futures, and it'll be settled against the CME pork cutout index, which is a weekly compilation of the 602 report. So pretty simple, pretty straightforward, and the contract months will be the same as lean hog futures, and again, maintaining similar specifications to futures. And so before we kind of go into the driving point on this, I wanted to throw this chart up here, and unfortunately for to I guess point out again the challenges associated with price discovery. When you have this wide of a range in the price that people are receiving for pigs, this happens to be last May, and we had at that time, some pigs that were receiving $30 over the index, and other pigs that were receiving $20 under the index on the same day. Huge discrepancy as it relates to price discovery, depending on the type of contract that you signed. And so, I believe that offering this cutout contract is one of the steps that needs to happen in order for us to start to improve this process. And so, I think what we could do here is just jump to this graph and slide and just talk about if you're a heavy cutout type producer, you might consider hedging against the cutout and locking in your basis without any basis volatility. Although up to this point, it's been a fairly positive basis for you. So that's something that we would want to talk through a little bit and decide what would be the best strategy. If you happen to be leaning more towards cash-based contracts, the two contracts trading side by side one another may present an opportunity for us to lock in a narrower margin than what may end up in the spot market or when those pigs get delivered. And so it'll be interesting to see how that looks when we start trading that contract, but there might be an opportunity there to improve our price discovery mechanism by using this new tool that's being offered to us. So I'm looking forward as that rollout comes out and starting to see the relationship and the trade between those two contracts. Looking forward to that potentially being an opportunity to help us manage the significant risk that we've seen up to this point recently on the wide variance in different contracts and how they're priced. All right, let me skip or wrap up there and skip over to livestock insurance. And so, as I mentioned at the beginning, this has been something that we've all been engaged in, and from a crop insurance perspective. But every time we've looked at this from a livestock perspective, it just frankly didn't look all that attractive to us. But again, with a little bit of subsidies coming through on one of the most recent spending bills that came through, I think it's worth taking a new look at. So just as a little bit of a precursor definition review, there's two different types of product. The first one is livestock gross margin, and it provides protection against the loss of gross margin of a swine operation, protecting against loss of margin due to a declining hog market and or increasing feed costs. So LGM, livestock gross margin, allows for you to crush the pigs, essentially buy corn, buy meal, sell pigs, like many of us have engaged in for the last 15 years or so. So it does create that opportunity. The other product that's available is livestock risk protection, which essentially becomes a put option that allows for you to defend the risk of lower prices in the hog complex or the cattle complex or the lamb complex, and it settles against the CME index. And so the first one is a full crush. The second one is just a protection on revenue failure or drop on the hog side of things. All right, so let's just talk a little bit about how that could look. It gives you the opportunity to provide protection against the loss of gross margin of a swine operation, protecting against loss of margin due to a declining hard market and or increasing feed costs. So it's a pretty simple calculation, and it does allow for us to split it up, in different types of operations. It can be farrow to finish, can be second graded early lean, or a finishing a feeder sort of a thing. The limitations are worth noting. You can only go out 6 months. It only gets offered. Initially it was getting offered once a month. I think they've recently changed that to once every 2 weeks. And so it does also provide the opportunity of a look back. For some of us that have been around for a while, remember LDPs and how you could lock in the LDP on the day prior at the FSA office if the market was moving. This is similar in that sense. So also something to keep in mind if there's a big market move on a day that this thing happens to be taking a look at, it might be worth considering. It is using options, not futures. So you do have some slippage into the market like options do, but your top side is open. And so just keep in mind that this crush that we're locking in is a minimum crush, not a locked-in crush. And so it does work. It does work in that way. The producer gets to choose what month to insure up to 6 months out, and how many hogs to insure each month. And then you also get to choose the deductible size, which essentially amounts to deciding how far away from the market would you like to lock in your crush. And so this last slide on insurance will just give you a little bit of a feel for how much the subsidy is. And so a zero deductible is about an 18% subsidy, and it goes all the way up to a 50% subsidy on a $12 to $20 deductible. So again, that subsidy side is the part that starts to make this thing at least worth considering. And again, we're anxious to get some of those prints and start talking about some opportunities there that may make some sense. All right, let's flip, if we could, to a little bit of a fundamental review. And last week's harvest rate at 2.484 was down 6.5% from the prior week, but up 12% from a year ago. And we've got a little bit of business going on there with holidays not syncing up. But I think more importantly, let's talk about where we are year to date. And this discussion, I believe, to be important as it relates to, everyone has an opinion as to how many pigs are backed up, are there none, are there, 2.5 million, that whole discussion. And let me just say that just bottom line harvest numbers, we've harvested 1.7% more pigs this year than last year. And I looked it up this afternoon. If I look in the last quarter of last year and the first quarter of this year, so pre-COVID, 6-month block, our slaughter rates were 5.4% higher, over 5% higher for that 6-month block before we hit COVID. So if we're only up 2% year to date, and we were up 5% when everything was normal, pretty simple math. There's 3% out there yet that either hit alternative markets or were euthanized, or they're still backed up in inventory today. I would just say that, I'm grabbing my calculator here, but average inventory in the U.S. is about 71, 72 million. So if I just take 3% of that, that's about 2 million pigs, just on the simple calc of backed up, that would say that about 2 million pigs would have either needed to find an alternative home or be euthanized, or they're still there. And so we're going to learn how this story ends really, really quickly here as we transition from above normal August temps and no paling to below normal September temps and new crop corn. So I'm the next 4 weeks, I believe, to be quite interesting, frankly. So I did jump ahead of myself a little bit there. This is another way that we're looking up the kind of the backed up number. The calc happens to be about 1.7 million at this point. And, there's every market analyst in this space has an opinion, and they vary greatly, and none of us are right, I imagine. So at any rate, it's an interesting discussion that likely doesn't have a real good answer. The other thing that's interesting that's going on right now is a large spread between the weights of packer-owned pigs and producer-owned pigs. And so this dark green dotted line here is this year. And packer weights have remained stubbornly high, while producers are down below. This is the lightest we've been in 1, 2, 3, 4, 5 years. So in the last 5 years, we've been heavier than where we are today. So I believe this to be a regional or geography issue. I believe that the Southeast, North Carolina, Tar Heel in particular, is a Smithfield plant that's still struggling to get to full capacity, and so therefore their packer-owned pigs down there are struggling with marketing. Whereas up here in the Midwest, the plants have moved past their COVID challenges for now, hopefully, and have been able to aggressively harvest pigs, and the producer has aggressively marketed pigs in an effort to get caught up. But it's a bit of a challenge, again, referencing above normal temps in August and no paline at all, and intervention feeding strategies that worked really well when they're trying to make the pigs not grow, all of those things. So, so my concern is that we've got another round of challenges here as we try to work through that backed up inventory that feels like it's not here today. All right, weekly pork production year to date up 2.5%, so 1.7 on slaughter rates, 2.5% when you consider weights have been on the average for the whole year a little bit higher than a year ago. I do believe that as we get into 2021, that pork production will be down 2.5%, or 2%, I've been saying. It'll be down 2% from 2020 levels, okay? So say that a different way. I think 2021 production will be close to where we're at in 2019. So I think there's been enough liquidation, both soft liquidation, euthanasia of small pigs, and sow liquidation, that we should see a production number down a couple percent as we go through calendar year 2021. All right, a real bright spot here is what pork cutout values have recently done. And this chart, the green line, if you can see that there, is sort of right on top of where we've been 3 other years, which is a significant improvement in cutout values from where we've been really back as far back as June. And so I'm very impressed, frankly, with the pork industry's ability to retool, focus on retail versus food service, and be able to move this much product through, well, it's a traditional stream, but no one is nowhere used to moving the type of volume that we're supposed to be moving through food service, but making up for it, I believe, through the retail. And that's a real success story that I think we should all be happy with our pork board and our regional and our state organizations and everyone else for all the help that they've done in being on top of teaching people how to cook pork at home again. That's a neat thing. So anyway, so cutout values up above $80 from a seasonal perspective and from a historical perspective. Again, quite impressive. And we're seeing it kind of along a couple different primals in particular. Hams have been leading the way, as have bellies. And so I point that out just to acknowledge that belly demand too has rebounded. And you think about bellies as being a food service item, really switched gears and is moving that product through retail pretty impressively domestically. And then hams, a fair amount of that happening as well, and also exports are picking up. I didn't put the chart in here, but the U.S. dollar, as traded as an index, is down in that 92, 93 area. We spent a lot of time at 100, 102 the last couple of years, and so the dollar, cheaper currency, it helps keep us better positioned to move product from an export perspective. And so we believe that we're seeing a bit of an uptick in ham demand, particularly into Mexico, perhaps into South Korea and Japan as well. So pretty encouraged on that front. One thing I would just say from an export perspective, and I think the storyline will be as we go through 2021, that we're probably going to see China start to back off. I think it's they aggressively expand their herd. I think they're going to net buy less U.S. pork as they go through next year. I'm optimistic though that some of these other destinations can pick it up. By the way, I don't know if anybody saw, but this afternoon, press release came out, and there's a wild boar in Germany that's tested positive for ASF. So we'll see how the markets and the different trade folks react to that. And I would guess that they've got some regional quarantines in place, and it doesn't completely shut down the EU as it relates to exports, but something to keep an eye on as we go through here the next week or two. All right, let me just, if I could, talk about some marketing tips here. And I thought this was important for us to spend a little bit of time on, because I've been blessed to engage with some of the best, neatest guys in row crop production, hog production, cattle production, and done it for quite a few years. And then, we're to the point now in our organization where there's 9 of us that engage with producers, and it's been fun bringing those guys in and talking about the best ways to engage with clients and help them make the right decisions. And this little table that we put together, I'm hopeful that it does a good job of sort of capturing a little bit of what I'm attempting to talk about here. And so there's really 2 components to managing risk for your operation. And let me just say while I'm thinking about it, this gets a lot trickier when you have multiple decision makers in your business, which many of us do these days. But there's really 2 different things that we have to think about when we go about making marketing decisions for our operation. And the first one is clearly financial risk, right? And I often tell the story that I spent a few years in north central Iowa for Cargill in Clarion, Iowa, and that was a marketplace that there just didn't seem to be a whole lot of risk as it relates to crop compared to, and I'll just say it this way before someone gets a little offended, compared to South Dakota. There's a big difference between risk tolerance, just geography-wise, on your ability to feel comfortable about the size of the crop that you're able to produce. And so that's there's a different financial risk associated with the geography that you're in. There's a different financial risk associated with what stage of your career that you're in. Many of us probably have a different financial risk today than we did 12 months ago. And we probably should think about that in terms of how we're going to go about managing our risk. And so, pretty simple concept. If we're in a critical financial situation, we're going to have to be more aggressive at locking in margin. If we're in a solid financial situation, maybe you have a tendency to engage more with option strategies or and see if you can wait for that next buck or two to lock in a little bit better opportunity. And then the next line down here, if I could, is talking about risk tolerance. And I can sort of go down the list of all of my customers, and I would argue that most all of them fall into one bucket or the other. And what I mean by that is that this is just the emotional side of these decisions that you have to make. Most everyone either has a fairly high risk tolerance, and they're bothered by missing market highs, don't like margin calls, don't like to sell today, it's going up tomorrow sort of thing. And then there's others, and then for whatever it's worth, I sort of fall into this camp. It doesn't bother me too much to hedge pigs, and then the market goes up from there. I just think I got another pig to sell. But I am bothered by, if I had the opportunity to lock in a margin that makes sense for my business and I didn't capture it because I got myself a little bullish or something, I'm a bit more bothered by that. And so hopefully, as I'm describing that resonates with many of you in terms of what side of the scale that you fall in on, because it's an important thing to understand about yourself when you go about making these decisions. All right, let me switch to some recommendations here. And what I'd like to first of all, let me just say that I think this is the most important slide in the deck. And so what 2021 is offering is, well, on the print here, $68.29. I actually printed this yesterday. today's opportunity is actually a little better than that, 68.66. So when I say 2021 average, I'm just taking a simple average of every futures month in calendar year 2021 and coming up with over 68 bucks. This year, the index is going to average around 57. So the market, in my opinion, is quite optimistic about the ability of some combination of increased demand and lower supply to give all of us an $11 a hundred raise year over year, or 22 bucks a pick. And so we've suggested to our clients that we should be relatively, well, by the way, let me just say one more thing before I move into that. The 2017, 2018, 2019 average, so the 3 years before this year, we've averaged 68 bucks. And so what the board is offering us today for 2021 is on par with what the market has offered the last 3 years prior to this year. And so we've been recommending to our clients that we be relatively aggressive, 35, 40, 45% in terms of level of coverage at these price levels in 2021. So everyone, I would just say that amongst a bunch of different reasons, but I'm particularly excited about having the opportunity to engage with all of you this evening, because we're right in the middle of, what's a pretty doggone good opportunity, and one that we haven't seen for quite some time. And so I'll get into the details and the nitty-gritty of our crush sheet in a second here, but this graph here that I'm circling is a 12-month crush projection that we track going all the way. This particular one goes back to 2014, but we go all the way back to 2002 on this thing. And we haven't had the opportunity to lock in break even since the beginning of the year. And then look through here in that 16, 17, 18 area. That was a pretty long run where we had a tough time locking in break even, or this solid line, which is a $10 target. And so I'm interested in using this particular little rally here to start to transfer some coverage or risk with this recent market rally. Before I switch to my sheet here, I did want to just point out the way that we figure cost of production is we have a tendency to sort of lump all of our fixed costs into one number. And so basically what we're saying is it takes 91 bucks a head, and the way these numbers are spread out, you can kind of see that there, how we get to 91. We say it takes $91 per head plus $111 or 111 pounds of DDGs, 464 pounds of corn, and 94 pounds of meal. So that's how we're figuring cost of production. And so this particular crush sheet takes a look from this month, September, for the next 12 through August of 21. Again, the futures market offering something a little better than 68. 3-year running average basis on the index, 67.60 on revenue, a 67.5, 67.50 cost of production. So just a slight little margin there for this time frame. And then if I just look at calendar year 21, instead of starting now and going through the next 12 months, so now I'm Jan of 21 through Dec of 21, happens to be a similar number, about a buck a head or so is the margin here. So so I encourage you all to kind of get teed up here a little bit and think about that. So I believe a nice little opportunity that just happens to be real time there. All right, Mark, I'm getting close to the end here, and so what I thought I would do is just take a couple minutes here and just talk about some of my thoughts as it relates to where the industry is headed. And so, really, we've been building sow farms since we stopped building ethanol plants about 10 or 12 years ago, and it's been pretty easy, frankly, for us just to replicate what we're good at. We're good at farrowing pigs. We're going to have another sow farm. We're good at finishing pigs. We're going to add a few more finishers. We like to make feed. We're going to get our own feed mill, that sort of thing. And so I think that this issue of first of all, interaction with the packer being a bit of a challenge in some cases as it relates to price discovery, one, and two, the challenges associated with just a really tough margin environment this year, I believe is going to permanently alter the way that we sort of think about what makes sense as we're engaged in this business. And so, instead of trying to replicate and increase volume and leverage your overhead, maybe what happens is we're more inclined to vertically integrate. That will challenge our core competency. It'll get us out of what we're used to doing, but it does do a very nice job in insulating your core assets. So instead of raising more pigs, let's become more profitable on less pigs is the general easy concept. And I think that we'll be able to get better at that as we move from 2020 into 2021. The next point is just managing your price discovery. It's critically important that we figure out a way to get better. And I know you've had one of the presenters talked about this as well, but I think it's important that we get the right price discovery mechanism, something that makes sense for your business, and then use the tools that are available to us to manage the price risk on it. And again, hopefully this cutout contract gets rolled out, and that's another tool in the toolbox that allows for us to do that. And then the next point is just sell the carry, sell the premium that the market is offering us. And I typed, make the market make you wrong. It's been a long time, frankly, since we've lost money on a short position, whether it be an option or futures or a forward contract or whatever. But I think we got to keep selling the premium that the market continues to offer and dare it to prove us wrong. If we sell 40% of our pigs next year at $68 and we fight those shorts all year long and the market's higher, hallelujah, right? We got past what is a very challenging time. Identifying foster key relationships. This industry is resilient. I'm fortunate to be part of it, but it's gonna be critical that we reach out to our packer partners. It's gonna be critical that we reach out to our feed mill suppliers. All of those people are contract growers and identify and foster the people that are going to help make you successful long term. All right, so again, I mentioned that Professional Ag Marketing is based in Laverne, Minnesota here. There's 9 of us that help with risk management. Would say that I know that hog production, hog engagement by far is the biggest space that we're in. And Mark mentioned that I too am involved in pork production and really, well, everybody on our team, I guess minus one fella, everybody on our team is engaged in some type of ag production. And we believe that to be quite critical and quite important, and it helps an awful lot in terms of our ability to help manage your business. So with that, Mark, I got it all wrapped up here. Is there any questions or comments that you might want to make?
Thanks, Pat. Certainly, I encourage our audience to enter any questions they have in the Q&A part there of WebEx. Pat, certainly our industry continues to change and the markets are dynamic, but do you perceive there's still a hog cycle that's unfolding, or has our industry matured enough that really isn't the case?
Yeah, so we always used to think about 4 years, right, Mark? And that hog cycle would run its course, and when things were going good, we'd throw a few more sows out in the pasture, and things got tough, they went to town sort of thing. And so we all know that isn't the reality of today's situation. But I do believe that we have a hog cycle, it's just longer. And so this, I mentioned we've been building sow farms for really what amounts to 10 years. And let me just say, part of that was wrapped around this when we didn't build sow farms for the 10 years before that, right? We had higher priced corn and the ethanol industry was expanding rapidly. And so this bubble pocket here of about a decade where our industry was expanding was, again, just a little bit of catch up from before, and then maybe, not maybe, kind of got overdone here at the end. But I think to answer your question, Mark, that yeah, there's a cycle. It's just a 10-year cycle instead of a 4-year.
Thank you. In terms of the insurance products, Pat, have you had many clients using them? I think certainly it's been a lot easier for people to use the LRP as it more or less relates to a put. The nice thing is you're not limited by size. I mean, it can be just a few animals or too many. The gross margin product, not many folks have utilized that over the years that I've been aware of.
No, that's right. And it was cost prohibitive without subsidies, in my opinion. So it hasn't been utilized much through the years. But I flipped to my crush sheet here, Mark, just to make this point. I think if this yellow line gets up to the $10 target, if you've got an opportunity to defend $10 with an insurance product, you're going to be quite interested, I suspect. So I think that's going to be the application, is when we get into some times where the opportunity is better than what we've recently seen and subsidized.
And I as well think it's certainly a tool that not many people have looked at, and yet I think it's good to be aware of and at least know what those numbers are.
You bet. Absolutely. And we do have those quotes available and are able to work with engaged producers on that program as well.
I think certainly it's an interesting time because the China demand has certainly been a huge part of our exports, and I think you touched on a little bit that you perceive that their demand might soften a little bit as we move forward. Anything else you'd like to add on that?
Yeah. So the trouble I have with the challenges I think they're going to be associated with China as we go through 2021 is we've all heard stories through the years of them just deciding to build apartments or build a hospital last winter, or build airports. I mean, they get the concrete trucks out and they focus on something. They make some significant progress as it relates to infrastructure. And so the story and the concern is those are the types of things that might be occurring over there today. A government-backed effort to significantly raise the available pork production in that county and that country at a very fast rate. And so I'm concerned as we go through 2021 that's going to continue to ramp up. They'll back off as it relates to purchases from the U.S. in particular. And then, of course, this whole issue of who wins the election in November and how we interact with the Chinese on trade talks and all of those things will also be a huge element in that. And it's hard for me to be terribly optimistic about how all of that goes, and that's another reason why I'm a little concerned about holding this demand up here at the levels that I'm suggesting that the market is offering today.
Pat, we do have a question from the audience. It said, could you please review your basis assumptions for your pricing recommendations?
Yep. So thank you for that. And so this column, if you guys can see that, is hog basis. And so what we've done is just taken the difference between the CME index and futures for each of those periods, each of those 30-day periods, and it's a 3-year average. So the index has averaged 37 cents under hereby futures for the last 3 years. Now, the challenge is that if your pricing mechanism is the index, no problem, right? This has been your basis. But anything else other than a pricing mechanism that would be different than that. Western Corn Belt would be bad, cutout would be good, kind of a thing, would significantly change what that basis is. And so, and we'll do that for our individual producer sheets and use their, what we would project to be their actual basis, depending on their pricing relationship.
Thank you.
Mm-hmm.
And certainly I encourage anybody else in the audience to submit a question for Pat. Pat, you're based in reality. How's the corn crop? How does things look around Laverne, Minnesota versus certain parts of Iowa?
Yeah, so Laverne is the very southwest corner of the state, Minnesota. We're 25 miles east of Sioux Falls, South Dakota, and just over the border in northwest Iowa there, Lyon County and Rock Rapids and all that. So our crop faded, really haven't had any moisture since the middle of July. We were on pace for a record crop at that point. I don't know if there's any question about that, but we haven't received a drop since then. So this crop has faded off quickly. It's died off early. They're just, I think 80% of it today is beyond the point of moisture helping a whole lot. So, so the little bit of silage reports that we've heard have correlated into something pretty close to average, which is helpful, I guess. But we've fallen off significantly from where we've been. My guess, Mark, is that Friday we're going to have the USDA's monthly guess on the size of the crop, and the average trade guess is a little higher than what I expected. I think they're going to be 177 and a half, 178 is sort of the average trade guess. So some belief that we can hold this crop around trend in spite of the challenges in the Western Corn Belt. I tend to think we're a little smaller than that. Maybe it's 175, 176, somewhere in that area. And so that does tighten up the balance sheet a little bit, Mark, but it doesn't create a huge challenge. And so, we're probably going to end up in the 2.3 ending stocks number, 14-15% stocks to use ratio. So a little tighter than what everybody thought 30 days ago or 45 days ago, but still, something that is relatively comfortable from where we've recently been.
So you're not as concerned about, in a sense, locking up your grain sources.
Yeah,
as
right.
livestock
So what
producer.
we're trying to do, especially in these geographies that dried up, is to stay as aggressive as we can from an end user perspective on cash corn. That's going to be a challenge in western Iowa and northwest Iowa and into southwest Minnesota. So old crop or new crop, whatever it is, we wanted to stay aggressive on that and make sure we get as much cash ownership as we can. And then we'll use some type of an option strategy out in July of next year, and just to defend ourselves against something changing fundamentally, but just kind of staying open, outside of some call option coverage as we think about the last 6 months of this crop year.
Do we have a follow-up question to that basis assumption? The same producer asked, if I'm on a southern Minnesota cash price, would you still recommend selling the futures for 21?
It's harder to be perfectly honest and frank. I would like to engage in that discussion and talk about ways that we can potentially change that price discovery. Like we can wave a magic wand or something, but that needs to be the first and foremost the strategy, frankly. After that, I would try to be a bit more opportunistic and try to attempt to get some of that lost revenue and basis out of the futures market, to be frank.
Another question from our audience. Are you hearing about any packer contracts that are offering contract-based contracts?
Probably not. I certainly, it's not appropriate for me to talk in specifics in terms of some deals that have recently been done. But I will say that that there's been some interesting creativity wrapped around combo deals, windows, things like that. So there's some activity taking place, but not a surprise to anyone. I think it's virtually impossible to try to get the kind of deals that we were getting 3 and 4 years ago on a cutout deal at this point.
In those combo, be it cash cutout, do you have any suggested range of what is the percentage of the cutout?
Yeah, here's the way to think about that. The index is par, and I think that the industry is heading to a cutout-based pricing system. That's my guess. And so the way to think about this is that I think we should try to negotiate a deal that is off the cutout. And if it happens to be something that's attractive, you should lock that in, and then now you're helping sort of pull the index. If we're unable to do that, then the desire would be to try to get something that would be index-based and allow for us to sort of jump on the wagon, and then hopefully the next guy that's negotiating a deal can improve mine, just the way that whole system works. And so I know I didn't answer your question directly, Mark, but I think that has to be the way that we sort of start to think about this. The concept of what we want to lock in, I think, should be cut out. If they're unable to do that, then we should try to do index and try to avoid having anything that would be tied to this cash market that has been a real struggle here recently.
I respect that, Pat. Definitely. Being selfish, I will even quickly speak up as we move into harvest, and certainly the drought corn or some of this wind-damaged Duroshi winds, certainly be very cognizant of corn quality for your breeding herd and your nurseries. Scout those fields, make sure we're not having a big mold and potential mycotoxin issue as we're now then going to harvest dry and try to store that grain for a period of time.
Yeah, great point, Mark. And that's part of the reason why we've chosen to get more aggressive to get old crop corn around us. A month ago or 6 weeks ago, we thought the spread was going to be really wide in terms of old crop quality and new crop. And now that gap has narrowed some as this crop has not finished well at all. In some cases, just plain a disaster. And so another intervention there is to try to stay after old crop and feed that just a little bit longer.
Does anyone else have some questions for our speaker this evening? Another question is, we've heard a lot of discussion about packers getting back to 95% capacity. Is that the whole plant, including processing, or are they prioritizing slaughter and rediscovering efficiencies on the cold side?
Yeah, great question. And first of all, I just say that 95%, I keep thinking about that as being their daily, weekly capacity. So if you've got a double shift plant that's supposed to do, 21,000 a day, and they're doing 20, you think that's pretty good, 95%. But the trouble is, you lose 1,000 head a day all week. The first 5,000 that you try to harvest on Saturday is just making up for the little bit lost all week long. And so 95% is a little bit of a misnomer in that sense. And as we get into further into September here, really the first half of the day on Saturday is going to be just about trying to catch up to what we're still losing during the week. That's the first point. The second point is that up until July or so, I would say that the packer was very aggressive in getting pigs harvested at the expense of further processing. I believe that's still the case today, but it's certainly something to keep an eye on. They've had, you know, my biggest concern as we go through the fourth quarter here isn't, you know, necessarily, which knock on wood, hopefully we don't have another round of COVID breaks in these communities, but it's just worker fatigue. I mean, these guys have been, and gals have been working Saturday since June now. And, you know, we need for them to work every Saturday in October and November and December just to keep up with the underlying supply. And I don't know how easy a job that is going to be accomplishing. So for me, at least, it seems the reality is that we are going to back up pigs here again for, you know, a couple, 3 months.
Any additional questions? We're not seeing any additional questions at this point, Pat, so I will wrap up our evening. But thank you very much for joining us, Mr. Pat Von Tesch from Luverne, Minnesota.
Thank you, Mark. Thank you, Mark. I appreciate the opportunity, and thanks everyone for joining us this evening. Our phone number and website is down at the bottom of the screen here, so please don't hesitate to reach out if you got any questions or follow-up questions.
Thank you. Have a safe and productive fall harvest. Have a good evening.